Welcome to The Derivative by RCM Alternatives. Send it.
Hello there. Welcome back. You found The Derivative, which is actually sponsoring the Uncorrelated Conference in Puerto Rico this week. So while you're listening to this, I'll be down there recording a live episode that you'll get to enjoy next week. On to this episode, we dusted off the solo six-pack format. No guests, no agenda, just me, a microphone, and way too many boarding passes. So grab some beers and settle in. Okay, 1. The conference circuit in the Allocator's dilemma. So I teased it there in the open. I've been traveling a lot. In the last 4 months, I've been through the following airports. Munich, well, we'll put O'Hare and Midway, our Chicago airports, then Munich, Venice, London Heathrow, West Palm Beach. I'm not calling it Trump International, sorry. Denver, Zurich, Miami, Cleveland. I was diverted there with some thunderstorms. Vancouver, Kelowna, Winnipeg, also diverted there. Toronto, had to land there to switch crews. Newark, LaGuardia, Fort Myers, and Orlando. That's not to brag. That is a cry for help to all the traveling consultants and sales teams who do this year-round. Props to you. How? It took me 44 hours to get home from Kelowna, British Columbia. I could have driven the nearly 2,000 miles faster. So my big takeaway there is I think we may have swung too far back towards in-person everything after COVID. But a lot of that travel was down to Florida for the conference circuit. So let me talk about the two big conferences on the Florida circuit, iConnections and Future Proof. First, some data points on iConnections. It bills itself as the world's largest cap intro event, and it shows. I think I had a meeting in booth 1745. That's 1,745, something like that. Yeah, it's huge. It's in the main conference center there. There's over 1,500 manager booths, some bigger Goldman and big manager booths. So price tag's pretty steep for the managers for the privilege of being in those little 6x6 booths for 3 days. I think it used to be better at the Fontainebleau. You used to go outside. You could get some lunch. They had seafood towers. They were carving steaks for dinner. Just a better scene and feeling. Now it's kind of very transactional. The food is shunted off during the day into a side area of the conference center that felt like where hedge fund dreams go to die. And then most people just commute between their hotels or whatever and the conference center. So you don't get that community feel you used to get with the cocktail parties and whatnot. And then I did hear some grumbling from managers who paid to be there and got denied food because they were 10 minutes late. That wasn't working for them. Although we did just have the managers on the last pod sing the praises of iConnections, and they built their business through that. So maybe it's just me getting old and cranky. So contrast that with Future Proof. Future Proof is a different animal. They're catering to RIAs. It's a bunch of ETF shops marketing to the ETFs. They're doing 4,000 plus attendees, 25,000 plus scheduled one-on-one meetings, special experiences. The event's held right on the beach there between 6th and 10th or so on South Beach on the sand, which is cool. So there's no suits. You're in shorts. You're in a golf shirt, flip-flops, sunglasses. So just to me, the difference, iConnections was guys in suits trying to survive the day. Like most conversations when you get in the booth started with, how you doing? You surviving? Like, yeah, 3 more to go. Where Future Proof is people heading to the booth where you can hold and pet puppies, then over to the spin cycle thing with a blender attached where you can mix your own margarita and get a little exercise. So long story short, I think iConnections could borrow a lot from their playbook. You're both down there. Maybe you do a deal with them and they could have the same beach setup that lasts for 2 weeks. Anyway, all that's to say, it leads me to a little bit of a deeper question. I was debating with some people down there. Should you actually meet your managers, right? I was down there. You're meeting with tons of managers. You're looking at allocating to them. You're meeting them face to face. My brain went to a little bit of like along the lines of never meet your heroes, maybe never meet your quants either. It's hard to take my human self out of the equation, right? Best practice is to meet face to face, do office visits, all of that. But what if you don't like the way they dress or they might smell or how they pronounce certain words? All that kind of builds up this bias in your head, which it shouldn't, but so be it. Some firms do this with a no asshole rule. No matter how good the numbers are, if they don't like the person, they're out. Some just say, forget about the person. I just want to see the numbers. Doesn't matter. And some are totally into the person and the numbers. I'm torn. It's hard for the right person to overcome bad math, I think. You could be the nicest, greatest person in the world, but your returns stink. You're probably not getting the allocation. But I think it's easier for the wrong person to overcome the wrong person to bring good math down, bring good math into question. You might say, yeah, I don't really want to work with that person or whatnot. So whether that should affect how you allocate capital is a real uncomfortable question with no real clean answer. Just a little sliver in my brain for you all to think about. Quick side note on iConnections this year, because there was one image I can't shake. Quest Partners, or Alpha Quest, as they rebranded to, they shut down in end of January, early February, after a 25-year run, and with $2 billion in assets. You usually don't see $2 billion firms shut down, but I've had clients with Quest. Nigel's been on this pod. I thought of it as a great shop dedicated to positive skew and kind of long volatility investing. Maybe in this Fed puts just buy Mag 7 world, that's all kind of feeling negative skew. It didn't work out, but sad to see. Anyway, they had shut down, but they were also had prepaid and were going to iConnections. So iConnections didn't get the memo, or nobody at Quest bothered to say, take our stuff down. So there was an empty booth sitting there at iConnections with the Quest branding. So there was nobody home, just sitting there in the middle of all the other 1,700 booths full of managers pitching their hearts out. It was like one of those frozen bodies on the way up to Summit Everest, where everyone just hikes past because they're too tired and can't carry the body back down. And just a brutal reminder that this business eats people. You can even be a $2 billion firm with a 25-year track record and still end up as an empty booth at a conference with nobody stopping, nobody putting flowers. The meetings just go on around you. It's generally haunting. All right, beer two, the Florida invasion. So spent a lot of time in Florida, a meeting, these two other conferences. I grew up there, as most of you may know. Vero Beach, a perfectly sleepy town, far away from international airports and all the South Florida action. We could get just in the right amount of trouble. So I think Vero's still mostly Vero, but from West Palm south through Miami, the whole stretch is being invaded by hedge funders and financiers trying to save on New York and Chicago taxes. But that's a well-known story. But what blew me away this trip, and I saw it with my own eyes, cranes, and this was mainly in West Palm, but cranes everywhere, entire blocks getting torn up and rebuilt, listings at numbers that would have been laughable 5 years ago. And a lot of it traces back to one guy, Steve Ross, who's the man behind Hudson Yards, the Dolphins, Miami Grand Prix. He's basically trying to build a second Manhattan, it seems like, in West Palm through his new group, Related Ross. He's looking to pour $10 billion, I think is the number there in a minute. Yeah. $10 billion into roughly 70 acres down there. Office towers, condos, hotel rooms, the works. So he just broke ground on a 28-story condo building, and late last year he locked up $700+ million in a construction loan for 2 office towers. The man's 85 years old and he's building like he's got somewhere to be. And it's not build it and they will come. Like the tenants are already showing up and lining up, it seems like. Goldman, JP, Elliott, Citadel, Icon, they're all based on Florida's East Coast now. I think one number I have here in my notes, they're managing something in the neighborhood of $300 billion. So the real estate market down there reflects it. Sitting with some friends in the real estate business, prices have doubled or tripled in a lot of areas. People are flipping houses for $5 to $10 million without blinking. And honestly, some of these hedge funders might want to quit their day jobs and switch over to the real estate license. You know, you have prices, commissions have ticked down a hair, but prices have tripled. Seems like a pretty good trade. The same friend summed it up pretty well, saying these people have a lot of money and not a lot of time, where price is not a concern. So that's not my main thing. I was struck by, I don't know if the migration is all upside. Kind of the same thing we talked a few weeks ago on the open snow pod. If you tell everyone where the powder is, pretty soon there's no powder left. So same thing here, it seems. If you tell everyone where to go save their money on state income tax, but your house costs 3 times what it did, and you can't get dinner reservations, you're sitting in traffic, didn't exist. Schools have become a real sore spot. We used to be one of the only private schools down there, St. Edward's, where I went to high school. People come from Stewart, from Melbourne, all over. There's some good ones down there in South Florida, but they can't meet the demand. So a few of these billionaires are pouring money into building new private schools, good enough for their hedge fund kids. But that just tells me everything you need to know about how planned out this was, really. And just to me, at a certain point, you're not saving money, you're just spending it differently, right? If you're Ken Griffin, sure, you're saving tens of, if not hundreds of millions of dollars. Life is good. But if you're a mid-level PM or someone who just works at the fund, you pulled your kids out of good school and moved to Boca because the founder wanted palm trees. I don't know if that's going to work for you long term. I'd love to see that spreadsheet of how that's working out. Of course, I'm the guy who willingly endures Chicago winters. So maybe I'm the crazy one. One more on this. Visited a couple firms down there. You've got guys in shorts, tank tops. It was just a weird vibe, and kind of the whole thing summed up to me is it feels like the whole hedge fund industry is having a bit of a midlife crisis. Bought the convertible, moved to the beach, unbuttoned the shirt, a few too many buttons. So it'll be interesting to watch from afar how that all plays out down there. All right, Beard 3. What the WTF is going on with bonds? I was beyond shocked. I was amazed, whatever the word is. Last month, when we started dropping bombs on Iran, you had stocks down, oil screaming higher, and everyone's favorite. All right, pack 3, bonds. What the F? Can I swear on here? I'm not a big swear, so I'm just going to let it go to BTF is going on with bonds. It was really crazy to see that Sunday night when markets opened after we started bombing Iran, you had oil screaming higher, stocks down, and everyone's favorite flight to safety, U.S. Treasuries were down. Rates were up. And what felt like a World War III preamble, no one had on their bingo card bonds being down. I don't know. I don't think that was in anyone's models. But there we were. War began, and rather than falling, 10-year Treasury climbed from basically 4 to 4.3-ish. I think it went about to 4.5 in March before falling back down to that 4.3. You know, really, they're saying, hey, if oil is going to be so high, it's going to cause inflation. We need to raise rates. So it's a inflation trade, I guess. But weird to me, this is just the latest in what has been a historically brutal stretch for bonds, right? We can talk about 22. We can talk about the rest of it. If I look at some ETF proxies, 7 to 10-year Treasury ETF is down last 5 years, 20 plus year down the last 5 years. Aggregated U.S. government bonds down the last 5 years. International bond ETF down the last 5 years. So it has not been a good place to be. But here's the thing in our world, managed futures world, people may not fully appreciate. Bonds have been massive fuel for managed futures returns for decades. Go back through some of the great CTA runs, late 80s to 2000s, GFC, and you'll find bonds doing the heavy lifting and trend following over and over again. And we're not just talking U.S. Treasuries, managed futures trade global bonds, U.S., German, boons, as they call them, Japanese government bonds, Aussies, Canadians, UK gilts, Spanish debt, so on and so on. It's one of the largest sector allocations because it's so liquid and there's so many of these good markets that you can express the view in. And when bonds are working, they trend beautifully across all of these. You don't need them all working at once, but usually there's something trending. And it's just been a really choppy, sloppy past 5 years in bonds. 22 was actually exhibit A for how well this can happen, right? SocGen CTA index put up one of its largest ever returns. That was mainly driven by the historic rise in rates, kind of the inflation scare there. But since then, we've just whipsawed. We kind of moved down to that new rate reality. And now we can't seem to either keep going with rates higher or get back to the old one. We're just stuck in this range bound thing for 5 years. So the numbers bear this out in a way it's honestly hard to believe. We went and looked at SocGen's trend indicator data, looked at their bond contribution to overall portfolio back to 2002. So the average 4-year contribution for bonds to the portfolio has been roughly 7, plus 7. The worst 4-year stretch ever recorded was minus 6.5. But 23 through now, 23, 24, 25, 26, I'm assuming 26 is a full year. You can ding me on that if you want. But these last 4 years, including the half 26, is minus 28. This isn't just bad, it's off the charts bad. Never before seen bad. 4 times worse than previous and flip the sign from what the average 4-year thing is. So if you're frustrated with your managed futures performance lately, I know many of you are, look no further than your friendly neighborhood bond salesman. That is the main culprit, right? These trend followers have been grinding out good gains in oil, gold, cocoa, the dollar, and then just watching bonds eat all that and then some to take us back to basically even over the last 4 years. One last note there, we'll put in the show notes. We did a pod with Roy Niederhofer a few years back. He was banging the drum that we basically had 30 years of bonds going up, rates lower, record low rates. That was a great trade for trend. He was saying that if you just flip that chart on its side and say, now it's 30 years of bonds going lower, rates higher, right? If it was just a mirror trade, he's like, managed futures would not do as well because you have roll costs, you have all these issues. So go listen to that. It was interesting. I don't think that's exactly what's happening here. I don't think he was wrong, but what's really just happening here is it hasn't found a new level. It's been too choppy. So anyway, will this continue? Surely not forever. Does it suck? Yeah, greatly so. All right, Beard 4, AI. I said last August in that solo six-pack, you can't have a podcast and not talk about AI in this world. So we're going to talk about AI. I've probably 10x'd my use from last August when we were talking about it, and I thought I was a heavy user then. It's just become part of my everyday life. But beyond me, in the last 6 months, you've had, right, a Substack post crashed IBM stock. Citadel came out and tried to talk everyone off the ledge. An AI podcaster asked a good, important governance question nobody's answering. And the way I actually do work, or the way a lot of us do work, has changed more than I think it has in the prior decade. So back in August, I said the end game for the AI race to me seems to be massive deflation and real trouble for the consumer economy. I still believe that, but somebody named Citrini turned that thought into a full-blown horror movie. So in February, Citrini, we'll put it in the show notes, Citrini published the 2028 Global Intelligence Crisis, a Substack. It kind of took my naive thoughts. I'm not taking credit for it, but basically took that same thought that this is deflationary and put real numbers behind it. Said, okay, which sectors, which countries, which things are likely to get affected the most by that. So basically they're saying agentic AI takes a step function leap. Companies automate, they slash headcount. The S&P rips at first, but real wages collapse underneath. The Michael Burry of the Big Short trade actually put it out on X, said, and you think I'm bearish. So IBM fell 13% when that came out, I believe. They got 16 million views. Wall Street Journal said it was a accelerant of investor anxiety. So anyway, they're talking about even if AI succeeds and those companies are making a bunch of money, and even if overall GDP is high because of that, they're calling it ghost GDP, and you're not going to see it end up in the accounts of the actual consumers that need to buy stuff. So problematic. So Citrini came out with that great thought piece. 2 days later, Citadel comes out, publishes a rebuttal, basically saying, hey, software posting, job postings are up 11%. AI adoption is remarkably stable, right? It's not seeing an upward hockey stick. They were saying Keynes underestimated the elasticity of human wants. But really, to me, it was just kind of this classic argument of this is the loom and new tech creates new jobs. Everyone relax. I guess that argument's been correct for 200 years, so maybe it deserves respect. But kind of for them to say, relax, everything's fine from a market maker that profits from continued confidence and trading and all the rest, didn't seem exactly disinterested. And more importantly, I think their analogy breaks. I think this is more than the loom. The loom replaced your hands. AI is coming for your judgment, right? So it's a fundamentally different kind of displacement. So next step there, good podcast. We'll put it down there from Dwarkish. I think it's called the Dwarkish podcast. Yeah. So he had a thing that was around Anthropic saying, no, they're not going to help spy on citizens or whatnot. So that brings up a whole supervision debate. To me, it wasn't about the supervision. It's more about if AI is replacing human judgment in certain cases, who decides what the morality of that judgment is? I'm leaning on my philosophy background here, and you can say, like a lot of people say, it's just brute force. There is no morality in it, but for sure, right? If you have automated car, if it has to hit the school bus or run over the old lady, there's a decision there. That's the classic one. So who sets those moral guardrails for systems that will be used by field generals, ER doctors, eventually almost every worker in every sector, right? What's the kind of base code that works its way through those positions? So right now, the answer is a handful of private citizens and private companies are writing those base morals. And Dwarkish does a good job of asking, like, is that what we want as a society? So go listen to that, raises a lot of interesting questions, right? And even I feel like the AI leaders themselves are begging to have oversight for this, right? Anthropic's founder, Dario, said its technology is similar to nuclear weapons and needs regulation on that scale. So anyway, we have the deflation thesis, we have a governance crisis, a lot of hand waving about the future. Our old friend Taylor Pearson brought it all back to earth with a piece called As We May Work, which we'll put again in the show notes. And that's a look at what's actually happening right now on people's desktops and kind of how we went from, and I love what he said, it's like original AI chat was like the movie 50 First Dates. Can't say it was a great movie, but it works in this case, right? 50 First Dates, I don't know what happens to him. Adam Sandler, he like bangs his head, and every time he goes back out with the girl, it's like they're dating anew. So those initial chat windows were like that, right? You had to start over and say, here's what I'm doing. Here's what I need. But now with Claude Cowork, even Claude Code, they're not about answering one question. They're restructuring knowledge work. So the AI is reading files, it writes files, it can write its own memory, right? It's learning your preferences and gets better at your specific job over time. So it's like a junior analyst who actually learns on the job. He has another good example from some guys in New Hampshire who beat some chess masters in what was called freestyle chess, was letting them use machines online. And they beat these guys not because they were better chess players, but because they could better interact with the machine, with the, wasn't quite AI, but with the chess machines, chess skill. So that's kind of leads right. That's the new skill will be who's the best at the prompts, who's the best at using it and collaborating with it. It's not necessarily going to be about the skill. So the numbers are real. AI agents cost $6 to $7 a day versus $400 to $500 for a knowledge worker. 4% of GitHub is already authored by Claude Code. It's projected to hit 20% by year end. And then just proof in the pudding on the day, Anthropic launched Cowork. ServiceNow fell 23%. Salesforce fell 22%. So there's real companies and real things at stake here. Last bit here, side note, I built out a small dashboard to track all the items in the Citrini piece and the Citadel rebuttals using AI, of course. I think that's a good way forward of like, if this deflationary recession comes to be, right, you'll see that rapid increase in AI usage. You'll see job postings start to go down. Even if the stock market's looking frothy, you could get some clues in there. All right, Beard 5, quick palate cleanser. If you've heard the rumors or if I mentioned to you at one of these conferences, yes, it's true. I was in Zurich, technically Mürren, Switzerland, to compete in the Inferno race. All right, I'll put a link in the show notes to a nice little video about this, but Inferno race called world's oldest and longest downhill ski race. A British chap, Sir Arnold Lunn of the Kandahar Ski Club, started it. Him and 16 other British skiers, including 4 women, did the very first Inferno back in 1928. And it's basically been going on ever since then, maybe a few years off for world wars and whatnot. But you're there in Mürren, you go up top, start at the top of the Schildhorn Peak. And when you're doing the full course, it's over 6,500 feet all the way down to the valley bottom, about 15 kilometers. Climate change, recently they've had to cut the course in half. So you only do the top half basically, which is what I did, which was about half of it, 7.5 kilometers. So anyway, we're talking me in a full downhill skin suit, 207 centimeter racing skis, the whole thing, actually competing, hit 67 miles an hour, finished as the top American in the 50 to 60-year-old bracket. Sorry if you thought I was in my 30s, and got a silver badge for being within 20% of the winner's time. So I don't think of myself as someone with a big ego. I'm a Midwestern kid, even though I was talking about growing up in Florida. But here I am on a podcast telling you about this. And damn if I didn't send race photos to nearly every human being I know. A few Uber drivers out there might even know my split times. So it's weird for me to be talking about it, but maybe it's the months of hard work. Maybe it's stepping out of my comfort zone. Although some of my friends would probably say screaming down a mountain at highway speeds is my comfort zone. Fair point. Or maybe it's the irony of spending my professional life telling people to manage their tail risk and then voluntarily hurtling down a Swiss mountain in spandex. But anyway, thought you should know. So do as I say, not as I ski. All right, last pack, a fun one for you. All this traveling and thing about this industry, right? Between conferences, airports, hotel lobbies, steakhouse dinners, we spend an ungodly amount of time in public restrooms. It's a weird thing to say, but every one of these stops involves washing and then drying your hands. So in my varied travels here over the last few months, I've kind of mentally came up with a ranking of the best hand drying solutions out there. So we're going to go from worst to first, top 10. Dead last, number 10, the continuous cloth towel loop, right? This is a Depression era artifact. Who designed this thing? You pull it down, receive a section of damp fabric 4,000 other men have already used. You might get the last 6 inches brown and moist. You leave with wetter, sadder hands than you started with, plus maybe ringworm. 9, the classic push button warm air dryer. This is the one in high school where someone scratched out push button, receive dry air, and had it say push butt, receive whatever. Anyway, you receive that gentle wheeze of lukewarm air, roughly equivalent to a golden retriever, breathing on your hands from across the room. Stand there for a while, give up, wipe your hands on your jeans. 8, the 2-hand pull-down paper towel dispenser. Sometimes when this thing fails, I put it at 10 as the worst because it is terrible. But you know that one where you have to pull exactly with perfect precision, both your hands at the same time. Your hands are wet. You don't have good grip. You rip a single like little guitar pick off there. You're clawing at it. Nothing works. Wipe your hands on your pants again. 7, the tiny single fold brown recycled paper towels. These aren't terrible. They're there. They do the job. Probably not great for the universe. You use like 30 of them and then throw them away. The biggest problem with them, you get wherever they're put in that trash can, a bunch of water on the ground. Anyway, not bad. 6, the built into the sink dryer. This is a new invention that I don't think needed to be invented, right? But now you have the soap, the faucet, and the dryer right there, all in the sink. But you're trying to dry your hands where there's water all around. Someone saw a TED Talk and thought that'd be a good idea. I don't think it really does the job for me. 5, I don't know if this should be 5, but 5 is that old school crank handle dispenser. I kind of like it because you kind of feel like you're doing something, like you're starting a Model T or something. 4, the motion sensor paper towel dispenser. I think this is actually where I started to think about this because at iConnections at the Miami Conference Center, the dryers are low and you couldn't tell if it was one of the pulls or if you had to put your hand in there. So you see people putting your hand in there, but you would wave it. Nothing was happening. Wave again, nothing. Cup your hands under there like you're getting communion. Wave frantically, nothing's happening. So feels like you're in an abusive relationship, and that machine has all the power. 3, the original Dyson Airblade, where you kind of put both hands into that super skinny slot. Way too loud, way too skinny. It felt like Luke Skywalker having to hit the exhaust port on the Death Star. Way too skinny. You have to perfectly get your hands in there, but did a good job drying. Number 2, the Accelerator, I think it's called, the wall-mounted jet dryer. This one's good, but super loud. Can't hear yourself think. Babies are waking up in adjacent buildings. And lastly would be the newer Dyson Airblade. No terrifying sight. Just hold your hands under and water gets blasted off like a wind tunnel. Kind of the sports car of hand dryers. And that's it. 10 hand dryer solutions that you never thought you needed to know about. All right, that's the show. Thank you. Quick 6-pack, and we'll see you next week. Peace.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.